Investors, we are on the brink of a revolution and I need you to invest in our IPO. We have created a super high-tech SOC location GPS system. Wow. To find that one SOC which always goes missing. Oh. Think about it. There are 7 billion people on Earth and 14 billion SOCs. The market size is huge, so who wants to invest?
Okay, something was definitely wrong with that founder. I mean, recently everyone's talking about IPOs, and more specifically, SME IPOs, because they're giving crazy returns. I mean, look at the SME index. It's up a lot. And we wanted to do this episode because a Yamaha showroom with 8 employees wanted to raise 12 crores, but got bids worth thousands of crores. In this episode, we're going to talk about the risks and problems of SME IPOs. We're going to talk about the good and the bad, because clearly the internet isn't telling you anything. Let's begin. So let's start by explaining what are SMEs. SMEs are small and medium enterprises or companies with less than 250 crore turnover. And SME IPOs are, well, SME IPOs. And these are different from mainboard IPOs. Mainboard IPOs mean the main IPOs you hear about, like Reliance or Infosys or Ola Electric. They're all part of the mainboard IPO, and the SME IPO board is different. So how are SME IPOs different from mainboard IPOs? So SME IPOs are listed on a different kind of board, which is the NSE Emerge and the BSE SME. This is different from the normal IPO board. Can you guess why? Well, first, it's not a really big business, so the resources are less. So their needs are different. So therefore, the regulations are also slightly different for SME companies. For example, the mainboard IPOs, after they're listed, have to release their financials every quarter. But not for an SME company. They release it once every 6 months. The other thing is that SME listed companies don't have to give as many disclosures and details like the mainboard companies. Because they have less resources, they're a smaller company, you might never really understand their business model, their CXOs, who they are, etc. So the information compared to larger companies disclosed publicly is lesser. And that's the problem. Investors don't go to people's factories, don't talk to the CEO, don't understand the team. All they really can go by is data. And if they don't have data, how will they decide on what company to invest? Especially if it's the retail people like you and me. Humko kaise pata? Hum utne smart to nahi hai, right? We don't have so much of resources to figure out if a company is good or not. And if you don't have enough data, your decisions wouldn't be as well informed as it would be for a larger company. So why have some IPOs really blown out of proportion? The reasons are obvious, but will shock you because it shocked me when I saw the numbers. 1, after COVID, there were so many Demat accounts that opened. So generally, after any IPO, number of participants increased, and it obviously increased for the SME IPO section as well. In fact, in FY20, the average of just 408 individuals applied to each SME IPO. That's the average. But the average now has soared to 219,000 people per offering. So the number of people applying has increased. The second reason is exponential returns. Let me show you a chart over here. This chart is the definition of a hockey stick curve. Look at that thing go. These are the returns of the SME IPO index. Look at that. And we all know how the market works. Demand, supply, no, greed. It works on greed. Anyway, let's continue. This index was launched in 2016. It had a value of 1,000 points. Now, if you look at the chart, in 2024, it's 16,000 points. Just think about it. 1,000 points, it's gone to 16,000 points in just a few years. It means in the last 5 years, the CAGR is 60%. And this is NIFTY, giving 12% CAGR. What is this? Guys, I'm being sarcastic. Of course, it's more risky to invest in something that has shot up a lot. And obviously, it does not make sense for you to do it. And I know the influencing army understands that. The third reason is a bigger investment opportunity. And to be honest, this is actually skewed and flawed thinking. In a normal IPO, when you apply, you can invest between 10 and 15,000 rupees. But in an SME IPO, it is 1 lakh rupees minimum. Now, I actually didn't know this until we actually researched and understood that it's 1 lakh rupees per person, which is pretty high. And my guess is this rule exists so that larger institutions invest and less retail investors invest. But it seems like so the retail investor thinks, I'll invest 1 lakh, it'll go up 50%. I'll make 1.5 lakhs. Even if that's true, there is another problem. Liquidity. Liquidity defines the number of buyers and sellers. If you have many buyers and sellers, it's easy to buy and sell the stock. If you have less, it is hard to buy and sell the stock. In SME IPOs, liquidity is mostly an issue. And you also have to buy and sell in lots. Let me explain. If you look at this over here, you can't just buy 1 or 2 shares. You actually have to buy the minimum lot, which is the minimum amount of shares. In this case, 1,200 shares. It's really difficult to do that because not many people will make a buying and selling decision at the price you want. So you get bad prices. So let me take an example of Resourceful Automobiles. If you've heard of this, good God, they had, I think, a 400x oversubscribed market and everyone thought this stock is crazy. They have a lot size of 1,200 shares. This is a great example because if you look at the screenshot, you'll see that day 1 and day 2 graph after listing, it's okay liquid, not a problem. But on day 3, the liquidity is almost gone. Look at it. But on day 5, there were only 6,000 shares traded, which basically means maybe like 5 people. But didn't they have like what? 4,800 crores oversubscription? 5 log? What? Why? And we found this interesting Reddit thread over here as well. Learned the hard way, bought an SME listing, down 50,000 of my investment. How do I recover? Someone said, wait 10 years. Someone said, what was your theory? And he replied, the GMP was 120% with oversubscription. Because of the oversubscription, I expected it to rise. But this liquidity issue is not just with one SME, it's with multiple. So if you actually go to the NSE Emerge website, you'll see out of 371 companies, 48 companies ka price has not even moved. It's not moved. That means there is no activity, there is no trading. Now, does this make SME companies bad? No. It just makes them illiquid. And can you make money from SME companies? Of course. But you must understand the darker side as well. Once you can manage risk, the upside can be decent. Now, a lot of people say small cap are very similar to SME, SME, small cap, SME. No, they're different. Let me pick a stock from small cap, which is Praj Industries. You've probably not heard of them. Over here, you can see that Praj, even on a bad day, has 46,000 shares traded in the last 1 month. So think about it. The liquidity there in a small cap company is still larger relative to an SME company. These are two different kinds of companies with different market caps and different liquidity. So don't think small cap is equal to SME. They are different. And now I want to talk about some SEBI warnings. So because the regulation is relatively little less in SME IPOs, SME companies, the chances of fraud increases just a little bit. Now, chances of fraud could happen in any kind of company. In SMEs, it's slightly higher because the risk is higher. Like recently, SEBI banned a company because they misused the IPO proceedings and, well, what can I say? It was banned. This is to you guys out there who are putting a large portion of your investment cash in just a really small company. And this goes for small cap, mid cap, large cap. You shouldn't invest everything in just one place, right? Unless you're a founder and have put all your money inside that one company and waiting for that company to grow. That's why SEBI has brought some regulations. One of them is limiting the maximum listing day gain to 90%. So the volatility is a little less. SEBI even said that some promoters may be artificially inflating prices. Remember, this can only be done in low liquid stocks. That's why SEBI introduced a new rule. If an SME company wants to list, in the last 3 years, at least 2 years should be positive cash flow. Sometimes the problem is none of the things I've explained. Sometimes the problem is just pure greed. Some people have listed SME IPOs without explaining the business model properly anywhere. And just because there's an oversubscription, investors out of greed just buy it. You, promise me, you'll never buy any IPO, mainboard or SME, just because it's oversubscribed. You buy an IPO because you believe in the company. I think you should think that you're going to own this company for the next 10 years. And if you can't do that research, probably don't invest in IPOs. That's probably a better way to think about it. So in conclusion, if rules around SME IPOs tightens, all these volatile gains will vanish. 2, IPOs do well when there's a bull run, when everyone wants to invest. So once the bull run is over, all this news about IPO gains will just vanish. And 3rd, the only reason you should invest in an IPO is because of its fundamentals and you want to own it for the next 10 years. Not grey market premium, not listing day, not oversubscription, not anything else. If you want to know about that, we've created a special video just around those terms and explaining what they are, so check it out. If you have invested in any SME IPO or normal IPO and found something interesting, tell us the story in the comments so we can learn from each other. Say the influencing army in the comments and see you in the next episode.